Good afternoon and welcome to AIADA's AutoTalk. I am Dan Barson, your host for the program. Today we are privileged to have some of the industry's leading analysts and economists. Joining us today will be David Lim. David is Vice President, Equity Analyst for Wells Fargo Securities. Tom Contos, Senior Vice President, Chief Economist for ADESA. And Jonathan Smoke, Chief Economist, Cox Automotive. Before we start, let's review a few administrative items. First, everybody that registered for today's program will receive a copy after the first of the year. Second of all, please stay on the line after the program for several important announcements. With that, I'd like to get started. Gentlemen, welcome to the program. I'd like to just start the discussion. I know last month, November, we had an excellent sales month. We're on track to do a SAR of well over 17 million. And basically, I just wanted to ask the panel if they felt this would continue and what their outlook was for 2018. And David, I'll start with you.
Yeah, so, the industry looks definitely healthy. Pent-up demand from the hurricane looks to be, has been largely spent. And from our channel checks, we're getting the impression that December figures are going to be really, really good. I mean, look, anything in the 17 million range is definitely a positive. I would say that next year we would anticipate more of the same. I mean, our official outlook is in the high 16 million, 16.8 million range. Could that go up or down a little bit? I think there's a lot of factors that are going to be involved. Our impression right now is that things look healthy. We've seen OEMs pare down on incentives relative to sales in the past several months, which is a good sign in our view, and inventory levels are also, moderating down. In general, we'll have to see how well the OEMs stay disciplined, and, it should be a good operating year next year in 18.
Jonathan, what does Cox look for next year? What are your projections?
Well, and this is a timely conversation considering we're anticipating a vote from Congress today on the tax policy change, which we think is likely to have an incremental improvement over last year. I would go directly with a lot of what David just said, that I think the best assumption about next year is largely more of the same or more of what we've seen this year. Yes, we're going to end the year, incrementally lower in terms of new vehicle sales relative to last year. We're on track for 17.1, possibly 17.2 as we end the year, and that's a decline from last year. But the good news is for most dealers is that they've seen sales of used vehicles grow even more than the marginal decline in new vehicles, because about half of that decline was in fleet sales. And so the net effect is we think the best-in-class dealers around the country have likely sold more vehicles this year. And with the mix shifting a bit more towards sustainable growth in the used vehicle market, that generally means that they're making more money off of the sales of those vehicles. We think that the environment has been somewhat perfect for vehicle sales for the last several years, and part of what has shifted this year is some of those conditions start to become, had been tailwinds and now start to become headwinds. So when you think about it, we've seen a gradual movement up in interest rates. That's likely to continue. We've seen a movement up in lease payments because of residuals coming down, and that's likely to continue to be the case. And we're seeing tighter credit, and that's the key reason why total sales may be up or equivalent to this year, but a continuation of a shift into used, because effectively the buyer of a new vehicle just a few years ago may be pushed into the used market simply because of the movement in the payment and what they can qualify for on the credit side. But in general, strong economy, very high consumer confidence, very low unemployment, now likely to become even lower with tax changes. And so the net effect is a continuation of what dealers have been enjoying already.
Okay, great, guys. We touched on this a little bit with both of your answers, but I guess are there any specific key factors driving the market? And what do we expect any major changes in those drivers that you guys mentioned? And Jonathan, I think you touched on that a little bit. What's the outlook for rates specifically?
So I think many of these factors you listed have certainly played a role in this year, some positive, some negative. Incentives have definitely been at or near record highs, but they've been stable as we get towards the end of the year, meaning we're not seeing panic mode on the in the case of the manufacturers, and that likely means the level of incentives are probably going to stay about the same, not getting dramatically higher, but also not declining. Interest rates, yes, that's a negative, and it will continue to be moving in a more negative direction. But offsetting that is, the reason for the higher interest rates is the economy is actually getting stronger, and of course that means even higher consumer confidence. We now are at a level of consumer confidence that we haven't seen in 17 years. So in general, that's very supportive of intentions to purchase a vehicle. It just means that with higher rates and tighter credit, more of those vehicles being purchased are likely to be used as opposed to new. But in general, as I mentioned before, I think that's very positive for dealers. And now with the tax change that seems imminent, I would say that if anything, we're probably going to see a bit of more acceleration in interest rates, but that coincides again with an even stronger economy. So a lot of these trends will continue to be the most important factors to watch.
David, do you have anything to add there? Anything stick out on the drivers?
Jonathan did an outstanding job on the economic factors, and definitely echo those points. I would just say, from an incentive standpoint, if we look at if we compare daily selling rates versus average incentives per unit, they have been steadily going up, and it's really been divergent in the sense that if we look at January of 17, for example, incentive levels increased like 16% per unit, but daily selling rates declined 2%, and we've seen that trend continue throughout 17, which just sort of illustrates the competitiveness of the overall environment from a retail standpoint. Now, what we found interesting is in the last couple months, incentive levels have still increased, but not to the level of what we've seen in prior months. But sales also have increased too. So again, it appears to us there's a lot more discipline in the marketplace, and just hopefulness. We would hope that continues into 2018. I think that would really make the environment a lot more healthy on a broad spectrum of things, including from a dealer standpoint as well as the overall supply chain standpoint.
Okay, guys, great. I think the one big issue that has been raised is the affordability issue. You walk into a showroom and look at the sticker on a lot of these cars, and there is some shock out there. And I believe last month the average transaction price reached over $35,000. I guess, can this trend continue, you guys? And at what point does affordability start to affect sales? David, I'll let you go first there.
I think this trend continues, as truck mix continues to play a role. In addition to added costs of emission systems and lightweight materials and advanced safety technology will continue to add upon the bill of material. For example, active safety systems could cost, the onboard cost could be just rough numbers, $500 to $1,000. Infotainment systems could be $250 to $1,000. So, the consumers are demanding these things, and obviously there's some level of regulation that's involved. I would say that, we're seeing more and more longer-term loans, and that's actually helping out from a monthly payment standpoint. Now, it's difficult to say what's the tipping point when it becomes so expensive that people decide, well, do I buy a new car or do I go for a late model used vehicle? Hard to put numbers around that, but as Jonathan pointed out earlier, I mean, economic indicators look good. So, I would say that again, trends will continue. The tipping point is a lot more difficult to ascertain.
Jonathan, go ahead, Jonathan.
I would add that it's already, from our perspective, impacting sales, and it's part of the movement that we've seen in 2017. That means the used vehicle market, and especially the nearly new vehicles, those less than 4-year-old vehicles that are largely coming off lease, and it is because of what dealers call the payment walk. When you look at it, it's really not so much the average transaction price, it's really what's happening to the monthly payment, because that's what matters most to consumers in terms of what they can afford and what they can qualify for from a loan perspective. And it's interesting, when you look at the beginning of 2015, the average lease payment was $400. Today, it's over $530. The used market seems to have a really sticky point right at a $400 payment threshold, and that's largely what we think is shifting demand is because of higher rates, higher lease payments. You're basically pushing some buyers into the used market, or better put, a buyer today that could have qualified for the exact vehicle they wanted with the payment that made it work in 2015 is now looking at, gee, can I buy that subcompact new vehicle for the payment that I can get, or can I get that really attractive 3-year-old SUV that's coming off lease and is certified pre-owned for the payment that works for them? And I think that's the trend that you should be paying attention to. And there's a demographic element to this. If you dig into it, what you really see is it's younger buyers that are most likely impacted by affordability and by credit. It's the millennials that people love to talk about that are the folks that are now more likely to buy those used vehicles instead of the new vehicles. And that may be a trend that's with us for some time.
Did we see the banks and captives buy more aggressively, or were they pretty consistent in 17? And what's the outlook for next year, you guys? And boy, Tom, I know this even hits on your end of the business with the delinquency and default rates. And David, since you're with Wells, I'll throw that one at you first.
That's a great question. I think, on the auto finance side, since I'm on the security side, what I could say is the way that banks go about it, everybody has their risk profile. And, the banks that have been in the business as long as we have from an auto finance side, we have like a deep knowledge of the models, if you will, in how loans will perform. I would say that, it's really bank centric, and the banks that, have the deep knowledge and have the models and the history are going to play, maybe play is not the right word, but are going to operate well within parameters that they're comfortable with. So, I mean, that's probably the limit of what I could really comment on relative to what we're experiencing, what we're seeing.
Hey, Tom, do you guys see any increase in repo volume through the auctions? Have you seen any uptick in that? Because boy, that directly, that relates to the delinquency default rates.
Yeah, it's a little hard to identify in the auction data specifically. When you look at it in total, to identify specifically just the cars that were repossessions. But to the extent we look at ADESA clients that are primarily repo remarketers, yes, we've seen an uptick. And the argument I've made over the last few years has been it's not an uptick due to credit quality slipping, but it's that there's more credit quantity outstanding as a result of new and used vehicle loans that have gone up over the last several years. So you've got more outstanding paper. And even if default rates stay stable, which, the different reporting agencies give sort of different metrics on that. So it's a little hard there to find out whether they're going up or down or sideways. I would say for the most part, default rates have stayed pretty stable at about 1% of, outstanding loans and leases. But if you have more outstanding loans and leases, you're going to have more repossessions even at a 1% default rate. And another observation I've made with regard to delinquency and default rates is delinquency rates might be going up, but default rates have been, as I indicated, pretty stable. So that tells me that lenders are sort of motivated to try to keep the buyer in the vehicle as much as possible and not have to repossess it. So those are just a couple observations on financing there.
That's a great point, Tom. That's a great point. Hey, Jonathan, you hit on this earlier, and guys, we don't have to spend a lot of time on this, but leasing. What is the outlook for leasing, and will it continue as a what will it increase basically as a percent of total sales? And what's the outlook on the CPO or used car leasing programs? Do you think that'll increase in popularity or even as an offering? And Jonathan, go ahead and take that one.
So this year has definitely seen some pretty substantial declines in leasing volumes. The lease penetration rate had reached, just shy of 33% at one point at its peak in early 2016, and the latest monthly data that we have from registration show that lease penetration is now around 27%. And it makes complete sense when you're a consumer and you're looking at a payment difference, like I mentioned earlier, that just a few years ago was $400 and now you're north of $500. For the consumer that's weighing the option of leasing versus financing, financing looks a bit more attractive. And when you dig into the lease numbers, what you really see is that leasing is holding steady and actually increasing slightly on the luxury end of the market that traditionally has been served by leasing. Where we've really seen the pullback is in the non-luxury vehicles. So, simply put, there are fewer Camrys, Accords, Civics that are being leased relative to what happened a few years ago when residual values were much higher. So the calculus has shifted. I feel pretty strongly, though, that we're likely to be reaching the end of the bottoming of that. We're probably going to stay at least at 25% or higher. And again, it's likely to be very supportive of the luxury segment, where leasing is a critical part of being able to get get folks into the vehicles that they want.
Got it. And I guess, guys, do we see captives and OEMs and or banks get aggressive in perhaps leasing programs for used vehicles? Is that a big untapped opportunity or not? And David, do you have any thoughts there?
My experience, I used to work for an OEM before doing this job. I would say that there's a lot of risk involved. When you're trying to ascertain residual values on a used vehicle, that's a tough calculus. Understanding that, I would say that I wouldn't put too much weight into that. I mean, maybe things have changed a little bit more, but my understanding is it's difficult, and at least from what I'm hearing, I really don't see that as like a major option. The others could chime in if they obviously if they've heard something otherwise, but that's the impression that I'm getting right now.
Yeah, David, I would agree that. Well, first of all, on this round of sort of plateauing of new vehicle sales, manufacturers have shown, I think, remarkable discipline with regard to trying to spiff leases. And it would be sort of counter to what's happening in the used car market in the first place, to spiff leases at precisely the time that wholesale values run the risk of softening and are softening. So I think that would be very risky, and I think manufacturers are keener to that risk than they might have been in the past. So I would think some of the slippage that Jonathan talked about in lease penetration rates has to do with the fact that if they're setting residuals based on market conditions, you would think that lease payments would be going up because you now have more depreciation to account for. So I'm not really surprised that lease penetration rates have dropped below the 30% rate. I agree with Jonathan that I don't think we're going to see that go below 25. I think we'll stay in that range between 25 and 30.
Good, Tom. Thank you. Hey, guys, I wanted to hit on this real quick, and all of you do not need to comment on it, but I think Automotive News several weeks ago had a series of articles that really made us all sit back and think about what's going on in the industry, especially around the retail end. And as we look at the consumer in particular, they've got a number of different options today available to them. They've got zip cars. They've got some of the dealers are rolling out subscription models where you can trade in and out of a car, while there's guys like me that still want to buy a car or lease a car. And I think a lot of that has to do with the millennials and the generations following them and their lack of interest maybe in something that's near and dear to all of us, the new car business. But what's the outlook as it relates to that, these non-traditional opportunities and alternatives? And Jonathan, I'll let you take that one first. Do you have any opinions on this? It seems as if there's a different model for almost every consumer out there today.
Yes, and I think one of the things you can bank on, Dan, is that we're going to continue to contend with more and more options, more and more alternatives, at least that are being tested, as people fundamentally try to come up with new ways to offer transportation than the traditional model of transportation, primarily coming from personal vehicles that are privately owned. But it is important to think just how long of a time frame are we talking about before we get to the true long term when some of these models might be a bit more sophisticated and capable of actually providing a compelling economic alternative for a consumer. And what you see today is that the more successful ones tend to be happening in highly urban areas where the expense of owning a vehicle is more expensive. So your analogy to zip cars, for example, or even the use of ride sharing tends to be most extreme in the places where it's very expensive to own a vehicle in terms of having a place to park it, to permit it, to you name it, and that's where you have a bit higher adoption. But when you look at the good old U.S. of A., our vehicle ownership rate is 91%. It's tough to see a lot of those models actually proving out to be economics that are beneficial to a consumer in many suburban and rural areas. So I think we need to be on guard in terms of paying attention to what are the innovations, particularly the technological innovations that help to electrify vehicles and bring down the cost of batteries and improve the range. But we're a long way off from it being a widespread adoption. Just a simple metric is only 1% of the new vehicle sales this year are electric vehicles, so consumers aren't exactly signing up for these alternatives en masse yet.
David, do you have any opinion around this? Does the bank watch these different specialties pop up, if you will? And
yeah, so I think on like robo-taxis, what we've been hearing is that the OEMs have definitely moderated maybe some of their volume assumptions on autonomous robo-taxis versus maybe what they thought was going to happen maybe a year or two ago. And I think some of what's driving that is that if we talk about autonomous, it's very hard to do. This is not easy stuff. And if you look at the onboard cost of some of these things, we've seen and heard estimates where the onboard costs of autonomous drive could range into hundreds of thousands of dollars as it stands right now with, multiple LiDAR systems, radar systems, camera, 360 surround, whatever, the software that goes behind it. So, this is a feat that is going to certainly take time to overcome. On the electrification side, what we found interesting, and not necessarily EVs, but electrification in general, including hybrid technology, we've heard through the grapevine for the last several years that it's coming faster than what maybe people are anticipating. So, EV take rates seem to be, from a global production standpoint, it doesn't necessarily, the mix doesn't jump. But if we look at like mild hybrid and a full plug-in hybrid, those numbers are really anticipated to go up. The underlying thing here is that there has to be a continued work down in battery costs and breakthrough in battery technology. Our understanding right now is a number of OEMs, and Toyota has announced this, is that they're working on solid-state batteries, and that could be actually come into full commercialization by the early 2020 time period. And with that at hand, that could be a really good driver behind take rates going up. So we'll see. I think there's a lot of question marks still behind electrification. I think a lot of OEMs are focused on this, and the reason is China is becoming a big driver behind electrified powertrains, and this is in the past, when the OEMs design a vehicle, they were more Western market centric, but I think a lot of that focus is really shifting on how do we address the largest automotive market in the world, and that is certainly China right now.
Listen, guys, I know we touched on this real quick. Let's hit used car performance. And Tom, what do we expect here? What are you guys seeing? Because, boy, that's a big driver of the auction side of the biz. Do we expect a record used car sales volume for 17? And what are the projections moving forward there?
I would expect, I'm a believer that the supply kind of creates its own demand. It's kind of an old economics law, but I'm using it a little bit differently than it was originally intended. In the used car market, when you get the supply, you're going to eventually get the sales. So because every used car will pretty much make its way back in, every used car that's coming into the wholesale channel will eventually make its way back into the retail channel. With the expectation that we will continue to see more off-lease volumes and probably more repo volumes, perhaps not as many dealer consigned units, because dealers hold on to more of the trades they take, plus they'll probably be taking fewer trades if new vehicle sales soften a bit. But really, and fleet sales are pretty muted right now, but there's still vehicles being cycled out of rental and commercial fleet. So when you think about all the moving parts in the wholesale channel, the likelihood is that we will see growth in wholesale volumes, maybe in the neighborhood of, 2-3, could be more than that %. So that would indicate, as long as those vehicles get sold in calendar year 2018, we'll see growth in retail sales of used cars in about the same percentage. The allocation of that between franchise dealers and independent dealers may fluctuate a little bit. We may see a little more participation next year from the independent used car dealers, since some of these cars will be repos and maybe vehicles that aren't coming directly to the franchise dealer from off lease. But, it's almost a 50-50 balance. So if there's, somewhere around 30 million retail used vehicle sales between franchise and independent dealers, I would expect that to tick up just a bit in 2018.
And Tom, you touched on this because they're related. On the wholesale volumes, how was the volume this year, and what's the outlook for next year? I mean, did we work our way through that tidal wave of lease returns, or are those still in the pipeline?
I never use the phrase tidal wave because really, if you go back, and I always say today's used car is yesterday's new car. So the new car sales growth post-recession was gradual. It took us a while to get to the 17 million range again, or even the 16, high 16 million range. So and lease penetration did have a significant uptick over that time frame. But so anyway, it's been the industry's had the ability to absorb the growth in off-lease volume in a fairly systematic way. It hasn't been a real tidal wave. We've had growth year over year, and that presented challenges. But, you know, and we touched on CPO a little bit. CPO has helped on the demand side, and just the gradual nature of that growth, I think has allowed the industry to do a pretty good job of absorbing the growth in volume in a way that didn't depress used vehicle values that much. You know, I think that'll kind of continue going into 2018. It might be a little more challenging now cumulatively because, you know, that many years of absorbing that volume, eventually, you know, you kind of get spent up demand out there, and there are the risks of more incentives on new cars. Though again, I applaud the industry for being fairly disciplined to this point. But that could change in 2018. We could see more spiffs on the cars, which would erode used vehicle values.
Right. So, Jonathan, do you have any comment around the wholesale side of the business?
Yeah, I agree with a lot of what Tom just said. I go back to the retail view. We do think that we've got this was a record year for retail used sales, and we think we're going to see similar growth again in 2018. Again, supported by the tax law change that's likely to be signed into effect soon. Underneath that, most of the growth that's occurring in retail sales is coming from vehicles that are less than 4 years old. So it's the very vehicles that make up that tidal wave that you were speaking of. And going forward, we definitely are seeing the growth in the off-lease volumes decelerate. For the last couple of years into the total auction space, you've had over 500,000 off-lease maturities in each of the years being added to the mix, and this year we're going to be less than 300. So we think that is providing the opportunity for those nearly new vehicles to reach those price points that I mentioned earlier that consumers are increasingly either looking at or being pushed into, and I think it's going to mean a continuation of the kind of growth that many dealers have experienced this year in selling those vehicles. On the wholesale side, we should be ending this year collectively across all the auctions with a record number of wholesale vehicles, and next year is probably going to be close to the same number again. That's because we are seeing some types of consignment volumes starting to decline. Dealers are consigning fewer vehicles because they have more retail opportunities and other alternatives. You're seeing fewer off-lease growth, less off-lease growth, so that's slowing down the amount of growth that we've enjoyed. And then we're also seeing declines, for example, in off-rental because the rental companies have downsized their fleets and have successfully gotten them to a level that looks a bit more sustainable than they have in recent years. And so when you add it all together, it means that the auction's going to present plenty of opportunities and plenty of inventory to be able to support strong retail sales, but we're probably not going to see the kind of growth that we've seen for the last several years.
Guys, I know we all touched on this, and that was incentives. Tom, you mentioned it and the discipline that you've seen. What does it look like for 2018? And David, I'll throw this one at you first. Do we expect to see aggressive incentives, money on the hood, or do you think it's going to, what's your take on them?
So right now, I mean, it's still incentives on a year-over-year basis. It still looks to be increasing, but the moderation relative to what we saw earlier in the year, makes us a lot more comfortable. Now, 2018 is a brand new year, and the issue at hand is, as everyone knows, it's prisoner's dilemma. There could be an OEM that want another 200, maybe 30 or 40 basis points in market share, and they won't relent, or whatever the situation is. So I think 2018 is like any other year; it's going to be fluid. But I'm really hoping that what we've seen so far the last couple of months, and granted, there was some help, there was some hurricane noise, but if we could be disciplined, that would be definitely helpful for the OEM community, helpful for the supply chain, and I think it'd just be helpful for a more healthy environment going forward. But never count out OEMs and what they want to do.
Yeah.
I would add too that it seems like it's more targeted kinds of incentives as opposed to en masse kinds of incentives that are being deployed, and maybe we'll continue to see that. So when I look at incentives these days, I break out incentives on cars versus trucks, for example, because you might see the average incentive go to $3,500, but as a percentage of the average truck price, that might actually be about on par with what we were seeing prior to that rise. So I mean, on a weighted average basis, incentives can be going up simply because there's more spiffs on higher dollar trucks, perhaps, or luxury vehicles than there are on small cars or mid-sized cars. So I think it's important to kind of study the incentives kind of in great detail. And I know David does a really good job with that and looks at the impact on new vehicle sales as well. So anyway, I think it will be more. I would hope that they'll be more targeted. They may be, as David indicated, selected by particular manufacturers to generate sales gains and market share gains. But I'm hoping the discipline doesn't break down too badly. And some of that was probably made possible by hard-fought, concessions after GM and Chrysler went into bankruptcy. With the unions, I think, have allowed more plant flexibility so that you don't necessarily have to build a car and try and sell a car and throw a lot of incentives at it. You can avoid building the car in the first place if retail sales have softened. So I'm hoping it holds in 2018.
Hey, guys, we're running at 40 minutes here past the hour. I'm going to just ask one more quick question. Interest rates, that so affects our business. What's the outlook for this coming year? I think we're going to have a new Fed chairman if we don't already. I apologize for not knowing that, but what's going to be the policy on interest rates, and what's the outlook for next year? And David, you're near and dear to that one. Can you take that one first?
Yeah, let's let the economist chime in first on that one, if you would.
Well, I think it's pretty clear that I think Yellen, I guess the last meeting here in December, one additional increase was approved, and we would probably see. It was pretty telegraphed by Fed standards that we would have 3 more increases in 2018 of a similar quarter point nature. So that's kind of what I'm going to expect based on what I heard. And we do have a new chairman, but that chairman is sort of carrying on the policies that were sort of already being put in place under Yellen. So I expect continuity, and I thought that was part of the nature of the selection of Powell, was to have new blood, but not necessarily anybody that was going to stir the pot too much. So I think we've got a pretty good, more than we normally have from the Fed. They're not being cryptic and veiled in their strategy for 2018, as long as the economy stays as strong as it appears to be staying, and inflation, that becomes the culprit that everybody's trying to make sure doesn't rear its ugly head too badly. So there's enough signs of full employment in the labor market, where we might start to see more pressures on wages and therefore prices. And I think interest rates will continue to rise. Whether that affects automotive lending directly, we might see automotive lending rates not go up by the same rate as interest rates in the economy in general, just because, banks and captives have always been pretty good about figuring out ways to not necessarily pass along the increased costs of funds that they face from higher interest rates and staying competitive on the lending rates for automobiles. So I think Jonathan was talking about payment differences and things like that. So to what degree these interest rate rises result in significant changes in the prevailing monthly payments that consumers will be faced with. I'm still pretty bullish that automotive lending will still be pretty good out there and competitive even in a rising interest rate environment.
Jonathan, do you have any comment around the rates and the outlook for next year?
Yeah, Dan, the Fed this year said they were going to raise 3 times, and indeed they raised 3 times. I agree with Tom that the new chairman that's I think sworn in February isn't going to be philosophically different from what we've seen from Janet Yellen. But I do think that there is probably more risk that rates move even higher in 2018. That could mean more than 3 increases if the economy picks up as a result of the tax law change. And I do agree with Tom that there is the possibility that the short-term rates move much more than the long-term, and that's indeed what we saw this year. But there's also the argument to be made that the long-term rates could eventually start moving more aggressively because the globe, we're seeing global economic expansion like we haven't seen in a decade, and that means the negative interest rates that have been prevailing in places like Asia, in parts of Asia and parts of Europe, start to go away, and that could put more upward pressure on long-term rates. So I think dealers have to contend with the possibility that the payments become more difficult more rapidly for their buyers, and likewise their own floor planning expense could be growing more rapidly. It's one of the negatives. The good news is it's a negative related to an economy that's getting stronger and stronger by the day.
Right. Guys, I want to thank you so much for taking time out this morning. Gentlemen, you were outstanding. On behalf of Paul Ritchie, AIADA's chairman, and Cody Lusk, our president, thank you for joining us today. AIADA is, always remember, it's a dealer-run organization based out of Washington, D.C. The board of directors is made up of franchised, new car, international nameplate dealers, representing every international nameplate. And they're all from across the country. We're very proud of our board. Very dynamic group. On behalf of the staff, again, have a great holiday, Merry Christmas, great selling, and everybody, thanks for joining us this morning. Thank you very much. Bye-bye.